Hey, stay right there. I'm really excited for two reasons. Number one, we have Ted Butler with us for a question and answer. And number two, once again, I get to present this using this format, which is really cool. We will have a replay, we'll have a transcript, and you can watch this, but you'll also be able to listen to this as a podcast. And as many of you know, we're doing this is a special broadcast. We're doing a question and answer with Ted Butler. Many of you saw the interview series that we put together. I broke it up into three parts. If you didn't actually see that, I'll show you how to see it in just a minute. I want to find out, first off, who you are and where you're from. If you could type your name in the chat box, either to the right or at the bottom. I'm Jeff Lewis. I'm in San Francisco, California. Ted, where are you?
I'm in Cape Elizabeth, Maine.
Cape Elizabeth, Maine.
Okay.
Great. If you guys don't know me, for those of you who don't know me, I'm Jeff Lewis. I'm the publisher of silvercoininvestor.com, Lewis Mariani Research.com, and we also have our forum at the 47forum.com. If you didn't see the article or the interview series that we put together, you can find it at lewismarianiresearch.com. Just type that into the address bar, and then at the top, the menu where it says Home, right next to it will say Butler. You can click on the Butler link. It'll take you to part one of that interview. They're all linked together, so you can read through, you can watch it, then you can click to part two and then see part three. It's all put together there. Now, most of you know my special guest, Ted Butler, but in case you don't, just to give you an example of his influence on me, the very last article that I read about silver yesterday, Wednesday, was by Ted Butler, and the very first article I read about silver in 2002 was by Ted Butler, and he's been at this much longer than that. I have four words to describe him that kind of came to mind this morning when I was thinking about it: preeminent, objective, almost to a fault. I'll talk about that in a minute. Persistent and consistent. He's preeminent because nobody matches his experience. He's been in the trenches analyzing the silver market for longer than anyone. He's been persistent. Really, he is responsible for getting his observations, his accusations in front of the regulatory structure, the CFTC. He's responsible really for 4 silver investigations over the years, and he's been consistent week in, week out. You can find his commentary at butlerresearch.com. Here's the link. Check him out there. I highly recommend it. And then back to the objective part, I think this is a way to lead into our first question. He's objective almost to a fault. It's kind of led to this situation where he's kind of ignored in two ways. I think his analysis, his commentary is ignored by the mainstream for obvious reasons. Most people don't know or don't care about the silver market, but if they happen to find out about it, usually it's from like a supply and demand kind of a direction, a commodity side, and then they dip their toes in. They may run across an article that he's written, and then they're immediately confronted with a huge technology language. There's a lot of details and a lot of information to cover, and a lot of people just their eyes glaze over. And the other way that he's ignored, I think, is in our own precious metals community. The loudest, the most vocal commentators, they have sort of a stake in believing that the price is a reflection, a real reflection of supply and demand. And if they were to go there, if they really were to, and many of them understand where he's coming from, but if they were to admit it, it would just sort of, it might ruin, it would, sort of sabotage the premise of much of the analysis and the commentary. And with that said, to jump right into these questions, I think that some of what Ted has brought up, much of what he's brought up over the years, I'll revise that, much of what he's brought up over the years has, despite this resistance, has crept into whether it's the unconscious or a consciousness where we're seeing now, even today, analysis that Ted's brought up years ago as sort of, it's being accepted now as fact and not a conspiracy. For example, we're now seeing many commentators, including me, are analyzing the Commitment of Traders report or looking at the COMEX inventory warehouse data that's produced by the CME. Especially we've seen that in gold. So despite the resistance, much of his commentary ends up becoming, I think, part of this. And as a lead-in, Ted, we discussed in our interview JP Morgan's accumulation of this massive physical silver long. And one of the most visible signs of this was the accumulation for their own proprietary account, and that you can see in the data that's produced by the CME every day. And in conjunction with that, you've noticed, and this is something that probably will become accepted at some point, but no one's really talking about this yet, but this frantic, and there really isn't any other way to describe it, but a frantic in and out movement of inventory among the COMEX warehouse system of silver bars, 1,000 ounce silver bars. And so the first question, Ted, is, are you seeing any change in that movement? And I guess the second question to go along with it is JP Morgan still accumulating, and while this isn't the largest amount of silver that they've accumulated, but it's the most visible sign. So let's start there, Ted.
Well, thanks for the lead-in. Yes, the answer to the question is the turnover, this massive physical movement of 1,000 ounce bars in and out of the six various COMEX warehouse continues. It varies a bit from week to week. The last couple of weeks were just absolutely extraordinary. One week was an 11 million ounce turnover, and last week was 8 million. This week it's cooled off. I don't know today's figures, but it's like 3 million ounces. All of these are extraordinary numbers. And just to set the stage, just to describe it, when I say turnover in the COMEX inventories, I am talking about physical movement. I'm talking about warehousemen taking pallets of silver, five 1,000 ounce bars to a contract, out of various warehouses, being loaded onto trucks, not Brinks trucks, container trucks, and then the reverse of that, taking it out of trucks and putting it into various, the six various silver warehouses in the COMEX system. So it's not a bookkeeping entry. It is a physical movement. There's absolutely no reason to be suspicious of the numbers that they might not be reliable, because there really is no motive that I can think of why anybody would misrepresent or lie about the movement. So it's taking place. The big question I have is, because this silver movement started at the most famous time, auspicious time in the history of the silver market, April of 2011, when we hit the high near $50 for the second time in 30 years. And since that date, this movement, this frantic movement, physical movement of silver in and out from the COMEX warehouses onto trucks, in trucks into the COMEX warehouses, has continued unabated for the last 4.5 years. Remarkably, I haven't seen this, and don't see it now, this type of warehouse movement in any other commodity. No other COMEX commodity, no other NYMEX commodity, not a London commodity. You don't see this kind of turnover. And I've been asking out loud for a long time, for the last 4.5 years, why is it taking place? I interpret it and conclude that it's a sign of tightness. The second question you had, Jeff, about is JP Morgan still acquiring and silver, and the answer there is yes. I'm up to, my guess is they're up to like 400 million ounces of physical silver that they've accumulated over the last 4.5 years. And this stuff in the COMEX this year, about 20 million additional ounces went into their own COMEX warehouse, the JP Morgan COMEX warehouse. And as you say, that's the most visible, and no one can deny that it looks like JP Morgan taking delivery on futures contracts in their own name and their own trading house account, proprietary trading account, and eventually being moved into their own warehouse, COMEX warehouse. So it's a small amount relative to the total amount that they've claimed. They've moved maybe 5% of the 400 million ounces I allege that they've accumulated this year. But then again, it's not chopped liver either. 20 million ounces is not an insignificant amount, but it's the most visible. It's the least I have to explain and justify as to why it's taking place. And fortunately, this movement starting in April of this year, this 20 million ounces or so that's been moved into the COMEX JP Morgan warehouse, it came after I made the conclusion, the allegation that JP Morgan was buying silver long before they confirmed it with this unusual taking of delivery on futures contracts and the subsequent physical movement of that silver they took delivery of into their own warehouse, where they don't have to pay somebody else to store it. They can pay themselves.
Great, great. Well, before we go to the next question, I just want to, well, hang on one sec. So before we get to the next question, I just wanted to take a quick poll here. Actually, just go in and acknowledge some of you. Dennis is here from Florida. Krishna is from Bangalore, India. Jay Daniel, hi Jay again from Alabama. Walter's here from Michigan. Nice to see you, Walter. Ark is here from New Jersey. Russ from New Jersey also. Mark from Ireland. We have Bill from New York. Steve's in LA, although he didn't say that, but I know. Peter's in New York. If you're having so if any of you are noticing an echo or audio issues, what you can do is you may risk kind of coming out and you may have to come back in, but you can refresh, or you can basically sign out of the webinar, then come back in and check it there. The audio sounds okay on my end so far, but I know Russ, you were having some issues. So John's in Florida. We have a few questions. First, Mike. Let's start with this one, Ted. Mike is asking. And you pointed this out in your commentary yesterday. We saw like the price went down like 45 cents and like at 5:30 in the morning, and then basically stayed that way all day. And who is that, and when does that stop?
Well, not soon enough as far as I'm concerned, as far as the stopping part of it. But what it is that all our markets, including the stock market, bond market, have been taken over, captured with these algorithms and high frequency trading. And the way it works specifically in COMEX silver and gold is that there's this giant constant battle going on between two specific sets of traders. One set of traders is what we call managed money traders, technical funds that buy and sell based on price change. They don't look at fundamentals. They don't consider supply, demand, anything like that. They're programmed to be purely technical traders, basically following moving averages. When the price goes up, they buy. When the price goes down, they sell. When the moving averages are violated. And against this group, this managed money technical fund traders, are the commercials. JP Morgan, and maybe about 30 other commercials. And they basically game one another. That's how the price is set in silver. It's not so much, nothing to do with supply demand. 99% of the time, it's strictly this changing of futures contracts, buying and selling of futures contracts on the COMEX. Specifically, what I think happened Tuesday when the price of silver just dropped suddenly, 5 o'clock in the morning, and then kind of flatline, stayed there the rest of the day. If you go back and see, the most important moving average, the moving average that, if it gets violated, usually attracts significant buying and selling, is the 50-day moving average. These technical funds, these managed money traders, follow a whole variety of moving averages, from 5-day to 13-day to 20, 30, 40, 50-day to 100 and 200-day moving averages. The 50 is probably the biggest, the most sensitive. And what happened on Tuesday is that due to the commercials and the high frequency traders and the algorithms basically control the price. They can put the price anywhere they want. And what happened on Tuesday morning at 5 o'clock roughly was that the computer jocks decided we're going to take this below the 50-day moving average, which they did. It was around the 1485 mark or something like that. And when the price goes below, it can be artificially fixed right then and there, not any trading volume. We just put the price where we want to put it. And this is the hard thing for people to fully grasp, is that the big volume and the selling that came in by the managed money technical fund traders in reaction to that breach to the downside of the 50-day moving average, it all came in after the price went down. In other words, the price didn't go down because the managed money traders started selling it 40 cents higher and then sold it all the way down. The price goes down with a thud. That's why you have these sharp moves up, these sharp moves down. There's really very little trading that takes place as that move is created. The volume comes in afterward, after the price goes to whatever designated level that the commercials decide beforehand. In this case, just below the 50-day moving average on Tuesday. Then the volume comes in. Then the managed money traders come in with their sell orders because they get activated, okay, their trading gets activated, okay, by price movement. So the commercials got the perfect setup. They know how the managed money traders are going to react at certain prices, be it up, be it down. We have a long history. Everybody knows it. It doesn't take you long to figure out where the technical funds, the managed money traders, are going to be buying and selling. We kind of know that beforehand, and it's kind of simple. It's just when the moving average gets violated. So the setup, the perfect setup, the scam that the commercials have is that they know this beforehand, but in addition to that, they have the ability to set the price. Okay, so they know, it's like a puppet with puppeteers. They know if they move their hands a certain way, the puppet's going to dance a certain way. And the puppet in this case is the managed money traders, the technical funds, and they're just being controlled by the people who control the price. That's JP Morgan's, anybody with a high-speed computer and market-making ability to be able to set the price. So it's important to know that. Now, that's kind of good in this particular case on Tuesday, because once you get enough managed money selling to the downside, then it's time we got to take it the other way, bring it up, which they did today. And the managed money traders will be right in buying today 40, 50 cents higher than what they sold on Tuesday, again, because they're being controlled. The price is being controlled, and therefore their trading decisions are being controlled by who's ever controlling the price. That's a simple explanation of like what took place on Tuesday. Why did we drop? It wasn't anything to do with legitimate supply, demand, or anything like that. And that's the problem. It's like it's phony. None of these traders, none of these managed money traders, and none of these commercials, which are mostly banks, have any legitimate hedging that they're doing. It's all pure speculative game on both parts. And that's basically the problem and lays at the heart of the manipulation, because prices are being set by these computer jocks then and not mining companies and not industrial consumers of silver. And it's true in a lot of commodities. It's getting worse. It's terrible, but it's against the law in my mind. But I'm not the enforcer of the law, because commodities are supposed to reflect actual supply and demand. No one can come up with any kind of legitimate supply-demand explanation for what took place to the downside on Tuesday or the upside today. It's strictly this game, this competition between the commercials and the managed money traders.
It's ironic that the HFT or high frequency trading has it's been around for a while, but it's just gained there was a book, I think Michael Lewis wrote a book recently. It seemed after, I think Joe Saluzzi, another guy, wrote an interesting book about it. In defense of high frequency trading is the defense is basically surrounding the idea that you need that these traders actually provide this market making capacity. And of course they would say that because they're market makers in the traditional sense, perhaps by providing liquidity, but it also enables them to set the price.
Absolutely. And they want to stray away from the real the purpose why we allow commodity futures trading, which has been around for 100 years. It's supposed to exist for legitimate hedging purposes, where an industrial user or producer of a commodity will look to lay off a price risk associated with that production or consumption to a willing speculator. That's why commodity trading is allowed. It's not just like another Las Vegas that we intentionally created just to let people gamble. There's an economic justification for commodity trading, and it happens to reside in offering legitimate hedging opportunities. The problem is what I just described that took place this week and is true all the time, is it has nothing to do with legitimate hedging. It's like, if anything, those miners that are aware, those producers that are aware that they're being scammed, in the sense that the price isn't being created the way it's intended to be created. Some have actually complained, took my advice and complained to the CFTC, but the CFTC is not in a position now to admit that there's something wrong, because they've kind of denied it, to me anyway, for the last 30 years. So it's hard to go back, just like it was hard for Volkswagen to admit that it had it resisted admitting that it had jiggered with the software. It's the same thing because the CFTC and the CME, that COMEX has denied for so long that there is any problem. The odds that they'll ever admit it, I would think, are remote because of the time that's gone by.
Yeah, and that actually answers a question that just came up about, it comes up all the time. It's like, why, especially for people who are just kind of new to this, like, it's so obvious. Why don't the regulators step in? And of course, we have this long history. You could, I believe there were 4 silver investigations. Maybe there are 3, but basically, I think, would you agree that we're just sort of out there now? There's no way that there's going to be any, even if it was Department of Justice or any other agency, like, I don't know who has jurisdiction here, but we're kind of on our own. You know, I mean, I guess that's a lead in. So like, how does this end?
Well, I think that you're right. I don't see at this point too much water has gone under the bridge that I don't think none of these agencies, I've approached them all. In fact, one I approached at your urging was the GAO, the General Accountability Office. But all of them, Department of Justice, CFTC, SEC, they've denied it so much that I don't think it's reasonable to suspect that they would take the lead. It does not mean that this crazy system and manipulation, artificial pricing, won't end, okay? But it won't end because of them. Where it will end, in the case of silver, and we might be seeing it now starting to develop, is a physical shortage, because this artificial price structure is basically a derivative structure. It's not occurring because of too much supply or not enough demand. It's an actual commodity, actual silver. It's strictly a derivatives created futures contract on the COMEX created price structure. And it's if it gets to the point, if a price stays low enough, long enough, according to the law of supply and demand, you're going to, a physical commodity, you're going to, if a price is too low, you're going to increase demand as a result of that. You're also going to crimp and reduce supply as time goes on, and that will lead to an eventual physical shortage. When that shortage occurs, and it may be developing now, when that shortage occurs, there's nothing in the world of derivatives that can prevent prices from rising under that condition. That's the final, the assurance that if prices are manipulated, as I contend, you know, how it will end, and it must end, all manipulations end. It will end by a physical shortage. I mean, in a child's parlance, a child's game, it's like the rock, paper, scissors kind of game. Something is always the most powerful force, and in the case of commodities, there can be no more bullish force than an actual physical shortage. And we're seeing it in the retail side of silver. We're not seeing it necessarily in the wholesale side, but we are seeing signs of it. And not to go back to it, but the turnover, this frantic physical turnover in the COMEX warehouses, silver coming in and out every day in tremendous amounts, is a sign that you know, the wholesale market is tight, and shortage is just a certain level of tightness. I mean, you get to the point where you know, you can't contain it anymore, and buyers come in and are encouraged by increasing prices that a shortage will bring, and it just got to burn itself out. So that's how it, you know, it must end someday. Just don't ask me which day.
Right. Well, you know, that question is going to come up. And I see that, by the way, questions are what I'd like to do is have people, and you're doing it, just type your question into the chat box, and I will go through them. We're kind of hitting on them. I'm with Ted Butler. Ted's in Maine. I'm in San Francisco. Thank you all for being here. One, you brought up the shortage. I think there's there's a question here about what is the U.S. Mint doing? What's the latest? There were two stories that I saw circulating today. One was I think speculation that the Treasury Secretary was suspending Eagle sales, perhaps. I'm not sure where that came from, but that was sort of a question. And then the other question was, well, we see, you know, I just saw an article today that was an outright denial. You know, it was almost as if it was sort of planted as a propaganda piece. It was like, there's no silver shortage. It's just anecdotal. You know, there's no hard, I mean, the opposite of anecdotal would be that there's some sort of objective way to analyze, like, whether there's a retail shortage, but there's also, as you point out, a difference between retail shortage and a industrial or shortage. So what the question, I guess, is, what's, in your opinion, what is it? What's going on with the mint, and what does it mean? Is it just is it more anecdotal evidence? I mean, by the way, the article that I saw that was putting down this idea that there was a shortage was using, like, it said that no, true price is, but because of the gold and silver ratio, so it was really it was kind of off. It was hard to accept its premise to begin with, based on what, the rest of the article. But Ted, what do you see happening with the U.S. Mint?
Well, you got to remember that the U.S. Mint, when you're discussing the U.S. Mint, we're talking about retail forms of silver, and you don't really have to go much further than the U.S. Mint to confirm the retail shortage. They've been rationing. They're producing selling by allocation, as many silver eagles as they can produce. It's not enough currently. So when you have to pay a much higher price, in this case it's a premium, on the coins, and you have to wait for them, that generally is the definition of shortage. Shortage, sometimes people will misinterpret it and insist that shortage means that none is available at any price, and that's not true. That's almost not possible. At some price, there will be material. In this particular case, because you can't get it in a timely manner and have to pay much more than has been, charged or paid before, it is a shortage. I mean, but it's a retail shortage. It's a retail form. That in turn has led to other delays and high premiums in other retail forms of silver, say maple leaf coins or 1 ounce rounds or 10 ounce bars. It starts to go up the chain. So we want to say that when you're asking about the mint is the prime place to look for confirmation of a retail shortage, because they just can't produce enough for a number of reasons. But they can't produce enough. If it's not available, you have to wait. That's a shortage. I mean, how intense the shortage is can vary. Okay, it's not a black or white issue. There's degrees here. But on the retail side, most people in the retail business, would confirm that these are tight shortage type conditions. Now that doesn't necessarily mean, and the critics or the people who are claiming that this is all tempest in a teapot, say that it's not really a shortage in silver until it gets to the wholesale market. When I say the wholesale market, I mean 1,000 ounce bars. If premiums, I think it's impossible for premiums, almost except in the most extreme circumstances, for premiums on 1,000 ounce bars to go up that much, because that's what all other premiums for different forms of silver are based on. The base amount is 1,000 ounce bars. It's industry standard. It's the silver that isn't used in COMEX. It's this form of silver in the big ETF. So it is the industry standard. 1,000 ounce bars, that's the wholesale market. If that goes into a shortage, then there'll be no equivocation. That's a shortage. That hasn't happened yet. Okay, there's no shortage that I can point to of 1,000 ounce bars. It would have to be reflected, in my mind, in the price were it going on. But that doesn't mean you don't get telltale signs, okay, beforehand, that a shortage or tightness might be developing. And we do have those signs. In the movement of physical stuff, there's probably about 5 or 6 different things that I could list that suggest that we could be going into tightness or shortage in 1,000-ounce bars. And it's important to recognize that it's not that unusual. We can have a shortage in any industrial commodity. It's hard for me to think of how we could have a shortage in gold, only because there's so much of it in the world. We don't use it up industrially like we have in silver. So it's hard for me to envision a shortage in gold because it's not consumed industrially. But any other commodity, whether it's copper or nickel or corn or oil or any other commodity, could go into a shortage because that's the nature of supply and demand. If there's too much consumption and not enough production, you can have a shortage. So it's theoretically possible. And in the case of silver, back in early 2011, okay, the reason in my mind why we ran up to $50, that last $20 or $25 higher in a relatively short period of time, is because we were on the precipice of a shortage. It was starting to be felt, and it wasn't. If you go back and examine the data at the time, it wasn't because of speculative buying on the COMEX. We have the commitment of traders that we can go back and review. It didn't appear to be a wild speculative binge that was driving silver prices up close to $50 in April of 2011. It was, by all accounts, a developing wholesale shortage that was, put to rest and delayed by the tremendous smackdown in May, on May 1st, that Sunday evening, and continuing through the month of May. That cooled off any investment demand and basically derailed what was a developing shortage. I would also say that at that time, that famous time in silver price history, April of 2011, that's when I contend that because there was a shortage, and anybody who was in the wholesale business, okay, would see it, and J.P. Morgan being the biggest factor in the wholesale physical side and future side of silver, they saw it, and that's when they made the decision that they were going to buy as much physical silver as they possibly could, which they've done over the last 4.5 years. That was the genesis to me of why J.P. Morgan embarked on accumulating as much silver as they could, because they saw with their own eyes that, hey, this thing can go into a shortage. Some people think it's impossible for silver to go into a shortage. I don't know why. We came there close once before, and as an industrial commodity, if demand is too strong compared to current production, current supply, then that's what a shortage is. That's why the word shortage is in the dictionary. It describes what could happen.
Thank you. Thank you for that. Let me see here. So Mike, so let's go back a little bit, Ted. You can hear me okay, right, Ted?
Fine.
Okay, good. So I'm just going to broadcast this question. First Majestic held silver back and complained to the CFTC. What do you think the probability of them doing that again, or that goes in conjunction with a question that Walter asked? Why are mines not backing down on sales at prices, set by this whole game? Why are the mines cooperating as if, the rest of them, as if nothing's going on?
It's a good question, but there's a good answer, okay? And the answer is they can't afford to. They're in the business of their sole income comes from the production, processing of ore and the delivering of concentrate, okay, to refiners. That's how they get paid. So it's no one miner, especially a smaller miner, say smaller anybody less than, say, 20 million ounces production a year. They don't have the luxury of turning off their income like any of us, okay, to achieve the goal of getting higher prices. There's no one, they don't make that much, no one miner makes that much difference, and to do it, okay, on your own is counterproductive. You're just going to be hurting yourself. I think it was good that they took my advice and they followed the format. They didn't improvise too much. The letter that I suggested that they send to the CFTC, which First Majestic did do, much to Keith Neumeyer's credit, didn't result in anything yet, but that's the way to do it. Okay, make an open complaint of manipulation. One of the things that the miners have been guilty of over the last decade or longer is that they don't speak up. You got people like me and people like me, basically analysts, speculators, whatever, complaining about the manipulation, but the regulators can come back and say, look, if there was a real problem, the producers would be complaining. So we're not inclined to listen to a speculator with a vested interest to seeing higher silver prices complain about the price discovery process and manipulation. Give us a miner who will say that. Now we got some this time, but they weren't big enough and vocal enough, and they weren't. Nobody joined in with them too much. But that's, in my mind, the way to go. Again, not that the CFTC is going to do anything. Even if you gave them everything that they would request, they're still not going to do anything. But you got to play the game the right way. Withholding silver individually is like, it's like spitting in the wind. It's going to come back at you. The other thing is, if these miners were to band together and align themselves with other miners and do it, watch out, okay? Because that's antitrust. That's you'll get the Justice Department coming, even though they won't go after the manipulators on the short side, okay, on the paper side of the deal. They sure as hell will go after any banding of producers, okay, that would be withholding supply from the market with the intent and express purpose of influencing prices higher. That's like that's prime antitrust material for the Justice Department. So they really can't do it. They can get in trouble that way. The only way you really can get out this whole thing, I think, is you gotta speak up. You gotta point to the problem, and coming from a producer, it should be taken more seriously than coming from an analyst, an individual commentator. That's kind of just the way it is. The problem is that nobody else, these miners seem to be content to watch their fortunes just dribble away because without saying anything, and that to me is crazy. I mean, why not do anything that you can do that's legitimate, that's low cost, and that's what I presented to the miners, and at least First Majestic did take it up, which is much to their credit.
Yeah, that was quite the development. Something that I was certainly surprised to see. So just stepping back just for a minute, when we talk about the into and out from the movement, between these in this warehouse system, you may have described it already, but how does it work exactly? I mean, John asked the question, are these literally trucks? And I mean, is Brinks, part of this? Like, this system, I'm assuming that this whole system is run by a set of very structured rules, and it's, there's official, it's very much rule based. And so I mean, is this movement, is this literally putting 1,000 ounce bars on pallets onto trucks and moving it from, you know, Delaware to, I don't know where they, I mean, they're all over mostly in the East Coast, I think, but what's happening literally?
Well, that's what's happening. I mean, that's why that's why I noticed the issue starting 4.5 years ago, and that's why I'm persisting in talking about it today. John's question is good. Like, what the heck is going on here? Yes, it's not Brinks trucks. These are, maybe you might have caught the news a couple of weeks back. There was a big heist of silver, $10 million worth of silver stolen from the port of Montreal, and I think they eventually recovered it, or they nabbed the crooks. And basically, what it was, a lot of people were surprised when they saw it, but what it was is that it's a container, like a ship container, like a rail container, like a container you see on the highway. The containers that are interchangeable, okay, between boat and rail and truck. These are containers, and one shipload. This is how they ship silver. They don't ship it in Brinks trucks. They ship it in these containers on Mack trucks, and one container, a typical container covers 600,000. It's never to the ounce, of course, but one truckload is 600,000 ounces. That's the equivalent of 120 COMEX contracts. It weighs about, from memory, 42,000 pounds, 21 short tons, and this is a typical truckload. That's why they ship it in 600. And one of these truckloads got stolen in the port of Montreal. Subsequently, I think recovered, or most of it recovered. And this is how they ship silver. And think of this: this 600 ounce is one truckload. That's the normal movement. It'll be 593. It'll be 610,000 ounces. It's never exact. Like a 1,000 ounce bar is never 1,000 ounces exactly. It's always a little under, a little bit over. You know, the same thing here. These are big trucks that are taking these containers of silver in and out of warehouses. Not the same. Every once in a while, okay, you'll get, you know, a transfer, certainly in the case of how the J.P. Morgan silver inventories have grown up in their warehouse over the last 4.5 years and over the last 4 or 5 months. Some of it comes from, and sometimes you can identify it, from one warehouse into another warehouse. But that's kind of rare. Most of the movement, and you get this as a daily release from the CME, and it shows what came in and out to the ounce, to the fraction of an ounce in the 6 different warehouses. And most of the time, it's like, you know, we know a lot. I'm telling you, you can verify the ounces that come in and out, you know, every day, every work day into the COMEX. And it's not the same. You don't know enough. It's like, you don't know where the stuff is coming from if it's not coming from another warehouse. You don't know where the silver is going to, okay, if it doesn't go in another warehouse, just taken out. It's this constant and frantic movement, these truckloads of silver coming in and out of these various warehouses. And John's question is good. Like, what the heck are they doing? Well, it's not make work, a product of making work and just employing people and driving city silver around New York area. It's done for a reason. It'd be implausible to think it wasn't. There's expense involved. There's, you know, the labor and equipment and all this kind of stuff. So no, it's not being done, you know, haphazardly, or it's not being done because it doesn't have to be done. Nobody undertakes an operation like this unless it's mandatory. It's required, and so it's real. It's happening. That much I can tell you. I can't tell you, other than my best guess, as to why it's happening. And I would solicit every single one of you, as I've been soliciting my subscribers for the last 4.5 years. If you have a different explanation, okay, I'd love to hear it, okay? All I know is that it's happening, it's verifiable. My best guess is that it's happening because such an inventory turnover. This is the second largest inventory on Earth, okay? The first is the 320 million ounces or so in the SLV. That's the largest stockpile of silver on Earth. The second largest, 167 or so million ounces, is in these COMEX warehouses. So I'm not talking about a minor, factor in the silver market. I'm talking about the second largest inventory in the world, and it's a fully documented movement, and it didn't exist prior to 4.5 years ago. And most importantly, it doesn't exist in any other commodity, just silver. So knowing all this, you try and take these facts, the movement and what's taking place and the whole logistics of the thing and common sense, and say, well, why is it being done? The best I can come up with is that it's an indication of tightness. Whenever inventory turns over frantically, it's turning over for a reason. And I would say the reason is there's just a constant demand for this stuff, that new stuff has to be brought in, okay, to constantly replenish it, okay, because it's going, one hand is going out the door, the other hand has to come in. And that to me is synonymous with a tight physical wholesale market condition that could very easily lead, okay, to a shortage. I can't come up with any other reason. As I said, I'll solicit. If anybody has any other explanation, they're going to tell me it's not taking place. Well, you got all these people, it's so many suits involved. You got lawyers and accountants and auditors and warehousemen and trucking companies and everything else. They're all going to be lying about this. I don't think so. It's happening, okay? It's not a phony number. The question is why it's happening. I've given you my best interpretation, but I solicit other interpretations.
Well, Mark has a question here. It may be related to something else, but is this because the ETFs are not backed by physical silver? And are they trying to cover this up? And, that brings up other questions about, the legitimacy of the SLV. There's lots of controversy. I know how you feel about it, but you can explain. But, do you think this has anything to do with the SLV, or again, is it just probably, it has something to do with the constant, stream of demand, that's going on. And also, Mark's question about the ETF, we want to get to that, but I also want to bring up or add on, we've seen various high profile stories highlighting this very same data, but for the gold market. And, the premise being, well, there's less and less gold in the vaults to begin with. And yet that's gotten so much attention, yet comparatively speaking, gold doesn't have, or there's no sign of this frantic in and out movement. So I guess that's two questions, Ted. Sorry to double them up, but
the movement is not taking place in gold or copper or any other COMEX, NYMEX commodity palladium. And I'm not aware of this movement taking place in any other exchange. Maybe there is this one gold that COMEX approved, this gold Brinks gold depository in Hong Kong, I believe. That's not really part of the COMEX system. It's a relatively new one, and they show a lot of movement in gold, but it's not related to this. I'm aware of it, and I just don't trust too many statistics from China anyway. And when I called the COMEX to inquire about this, they were like in the dark, the people I talked to. It wasn't really a COMEX warehouse in the sense of the silver COMEX warehouses, the copper COMEX warehouses, the gold warehouses, the platinum, palladium, and the NYMEX. So I'm aware of that. As far as and I don't think it applies to silver. Silver's still unique. As far as there may be some connection between some of the silver either eventually going to or coming from the SLV, but you got an ocean apart, and it's not the most convenient thing to ship back and forth. We have some turnover in the SLV, and it is counterintuitive. In other words, without getting too detailed, some of the deposits and withdrawals from SLV are taking place for reasons that you wouldn't normally think of. It has to do with, I think, avoiding SEC shareholding requirements and moving silver around that might be needed elsewhere. But I don't have any reason at all to doubt and I know a lot of people doubt it, but not me. The silver that's in specifically the SLV, in the sense that, and again, I'm not being overly influenced by it, but I did a number of years ago after the SLV was introduced back in 2006, 2007. I petitioned. I wrote a couple of public articles. I petitioned at the time the sponsor, the owner of the SLV, which is Barclays Global Investors, to provide the bar numbers, the serial numbers, and the bar weights and the hallmarks of the silver that they had, on deposit. Because up until that time, they weren't doing it. They were the GLD people. State Street was the sponsor. Basically was listing the serial numbers of the 400-ounce gold bars that were in the GLD, but at that time, Barclays wasn't putting the serial numbers and making them public. Well, make a long story short, they didn't hesitate, and a very short while, weeks, certainly not months, but not too long, they agreed to do it. So all the bars that are held in the SLV, and there's got to be 32,000 1-ounce bars. You can go to their website and get the serial numbers and the weights, and there's such a chain of responsibility in this stuff, big names, and some of them are JP Morgan, admittedly, but not everything that they do is crooked, it's, if you want to look at it and say, oh no, they're just lying about the bar list, and they're lying in BlackRock, the largest money manager in the world with almost $4 trillion worth of assets under management, whose reputation would be shredded overnight if it turned out that the silver wasn't there. You got to draw. I'm suspicious of a lot of things, maybe more so than most people, but I kind of draw the line at you really got to bend over backwards to assume that the metal isn't there. Now again, it's not a big deal. I'm not trying to convince anybody to buy the SLV. I own it, but I'm not trying to convince. I don't get a commission on it or anything like that. If you don't want to buy it, don't buy it. And if you're more comfortable holding real silver, that's fine in possession. The problem is you get so much damn silver for the money. It doesn't seem that way when it goes down on you, but you get so much silver for the money that at some fairly low level of investment dollars, you gotta have it stored someplace. You can't handle it yourself. These bars, these 1,000-ounce bars, if that's what that's always the closest to the price, represents the best value. These things weigh 70 pounds. It's like, it's not, reasonable to expect that you can, and it only costs, it only costs like $15,000. $15,000 is a lot of money, but 70 pounds is even more in weight. And from a practical point of view, if you were to put a sizable amount of money into silver, you got to have somebody store it for you, and you want to pick the best storage mechanism possible. That's an important thing. You want to be safe, and you want to be sure that where your silver is, where it's claimed to be, is there, and you want to make sure you don't get your own serial numbers when you're a shareholder in SLV. But if you're storing silver, say at one of the COMEX warehouses, which a lot of people do, say Brinks, you want to make sure you have the weight of that bar, the hallmark of that bar, the serial number of that bar. That's the only way to own it. There's two different kinds of silver. There's silver that you store that you got all that information on, serial numbers and weights, etc., and that's the real stuff. Okay. Or you get a pool account, an unallocated account where you don't get the numbers. I would be very suspicious about any form of silver that I was storing that didn't have the serial number, that didn't have the provisions that I could go get that bar, have it delivered to me at my cost. That specific bar, not another bar. That's the way you'd want to professionally store silver. It's people lose money. This outfit that just went out of business, it's going to cost people about $20 million. Wasn't just silver, Bullion Direct. They were claiming to be storing silver and metal, gold and silver for people, and it turned out they weren't. How can the individual protect himself? You got to use some common sense. The first way is, if you're going to be investing in 1,000-ounce bars, because that's the best value, you want to make sure it's either in an ETF that you trust and it's physically backed, or if you have your own storage, you want to make sure you've got all that information, the specific details. That's how, by the way, that's how the suit against Morgan Stanley several years ago, 10 years ago, I guess, I'm getting older, came about. I had a reader who I kept saying what I'm saying now, okay, about have the serial numbers and whatever. He says, look, I got silver at Morgan Stanley, okay, and they won't give me the serial numbers. What should I do? And I said, well, look, Selwyn, you don't have silver. If you don't have a serial number, you don't have silver. They don't have it. I'm not saying they're not going to be good for the money. They're not going to go out of business because of the 5,000 or 10,000 ounces that you own there. Okay, but at the same time, they don't have the silver, because there's no reason why they wouldn't give you the serial number. So he persisted, and he got a lawyer, and the lawyer filed a class action lawsuit, and he was the lead plaintiff, and they paid like $2 to $4 million in fines, but it's addressed to the same issue. Is that you got to be sure the stuff is there as is reasonably possible.
Thanks for that. I wanted to. We just actually covered storage, private storage, in a little interview that we had. Steve, it wasn't this call. Helped us out with that. There's a question here from. I think this might be a good way. We're into it for about an hour now, and so maybe just a couple more questions, if that's okay with you, Ted.
Fine.
So Dennis asked a little bit earlier, a question that I think that, this comes up from time to time. So the question was, I can buy silver from other countries, and there doesn't seem to be a shortage there, and the price is not fixed. And I think that's a statement rather than a question, but it made me think of, a question for you, Ted. Like, there are all these different exchanges for silver in the world. Why is COMEX the center of the world? Why do all world price of silver key off of, what's discovered at COMEX? And, why not SLV? Why not Hong Kong? Is the London market a separate price discovery market? Are the prices that you're paying in London, or in, someplace else, maybe I'm not asking the right question, but can you elaborate?
Yeah, it's a great question. It's like the COMEX is the center of the gold and silver universe, okay? And copper is that. Even though it's supposedly there's trading on these other exchanges, it's I don't think it's true. I think London, the LBMA, is like the guy on the Wizard of Oz behind the curtain. I don't trust any of their statistics, mainly because they don't provide that many statistics, and they don't provide them in detail. They come out once a month, okay, give you a volume figure for what they traded in a month, and that's it. And whereas with the COMEX, you got like this exquisitely detailed information, data on every aspect of the trade. I don't think you get anything in London. But for whatever reason, the COMEX is the price setter. Everybody follows the COMEX. I don't know if it's a combination of tradition. It's a combination of that's where all the big guys go. You certainly, you wouldn't, following the price action, it seems that 99%, even, you got to remember, the COMEX is a 24-hour, 23-hour a day market. So even when you're looking at something like happened on Tuesday, 5 o'clock in the morning, that it went down, somebody said, oh, they must be selling in London, or they must be selling in China, wherever. They're not selling anywhere. They're selling on the COMEX. It's all an electronic market. It's all done, okay, in the COMEX, Globex system, and we accept it. It's just everything in the world is priced off of the COMEX. There's a basis trade. In other words, it's just the way that it is, and it's what's enabled the thing to go a little bit haywire. I admit that it's kind of crazy that one exchange would have such a powerful, inordinate, dominant control on pricing. I'm not cheering it, okay? I'm just admitting it. I'm just observing it. If you're looking at why prices move, all you got to look at is what's happening on the COMEX, and what's happening on the COMEX is reflected in the Commitment of Traders report. And while I can't predict what's going to happen, tomorrow or next week or whenever, I can explain what has happened, okay, to prices and why prices have gone up and down. And it goes back to this silly game between the managed money traders and the commercials. At one time, many years ago, 30 years ago or so, it was a situation where it was always the commercials. It's always the banks on one side of the equation, okay? There's always somebody else on the other. 30 years ago, 40 years ago, it was basically the little guys hanging around brokerage offices throughout America, okay, that were buying and selling on an individual basis. But they were also mostly deploying technical considerations, and they were basically the counterparties to the commercials. That's changed. The little guy doesn't trade futures as much. He's not as dominant an influence in the market as he once was. Everybody's turned everything over to professional money managers, and so now it's become the managed money traders against the commercials. It's not right, and what's happened, it's enabled this artificial pricing structure to come into being, because just a set of confluences. It's already accepted by tradition. I mean, you just can't set up an exchange. Okay, I hear stories from time to time that there's going to be a new exchange in China, and they're going to trade gold on a fully allocated and backed basis, and stuff. That you don't do that. Everybody's plugged into the COMEX. They have to have a very good reason not to get unplugged from the COMEX and go elsewhere. And invariably, inertia and momentum have a lot to do with it. It just developed. I mean, we could argue or discuss why it came into being. Maybe I'm not portraying it exactly, but the reality is that's where the COMEX is where the price is set. It's not set anyplace else. I do notice, though, from time to time, like when the SLV is open for trading, it's a limited time, 9:30 Eastern time to 4 o'clock with the rest of the stock market, that sometimes it can have some kind of an influence on the price of silver that it doesn't have, obviously, when 5 o'clock in the morning or something like that. But it's a COMEX operation. It's just the way it is, and it's just why. Okay, it's morphed and it's turned into be this manipulative price discovery process. You're preaching to the choir. That's why we have a manipulation, because the COMEX is so dominant.
Thanks for that, Ted. We have one more question that I think is on the minds of many people, especially originally we set up this question and answer to kind of follow up with our interview, and we covered the heart of it was how did JP Morgan accomplish or accumulate this giant physical hoard. And I think a knee-jerk, not a knee-jerk, but like a reaction, a simple reaction that we hear often. I'm not sure if we covered it in the interview now that my memory is maybe I'm getting old too, but the why couldn't, do you think, I mean, is it possible? How could they do this? But could JP Morgan just, if the price started moving up, Russell made a comment, about gold, if gold moves over 1150 or wherever it is, or if we hit the next, big moving day average, the 200 moving day average, and price starts taking off. I mean, certainly they could come back in via the paper market, but could they utilize this big physical long, I guess, is the fear?
Sure. You're asking me, is it possible? Sure. If you own something, you can't tell somebody you can't sell it. It's like, so is it possible that JP Morgan could use the physical, the 400 million ounces that I allege that they've accumulated in the last 4.5 years? Okay, could they use that to keep the price of silver depressed for as long as they could supply silver to the market at any price that they cited? Is it possible? Yes, of course it's possible. It's like, but is it probable? And is it likely? And I don't think so, because JP, you have to take an objective appraisal of JP Morgan, why they exist. Just like a shark is a perfect eating machine, supposedly, okay? JP Morgan is a perfect profit machine. It's what they do. They just make money. They steal from their customers and others blind as much as they can, which is reflected in the many billions of dollars of fines and settlements that they've accrued, that we all are aware of. But it's all in the pursuit of profit. That's the common denominator. That's what makes JP Morgan tick, is the quest for profits. They have a situation here, if I'm correct, and they've got 400 million ounces, and I tell you that they should be in jail, because they acquired that 400 million ounces predominantly on lower prices that they were instrumental in causing to be low and declining, virtue of paper short sales on the COMEX. Okay, talk about a perfect crime. So they lowered the price, and they've accumulated all this silver, 400 million ounces at a highly advantageous price, higher than it is now. I say it's got to be in the 20s, their average price, maybe more. But will they turn around and sacrifice that? I mean, I don't think so. I mean, these guys are in it for the money. They don't care about anything. They'd steal their grandmother's eyes if there was a buck in it for them. So to take a 400, look, if silver goes to, $100, which I think it could probably go more than that, okay, but it goes to $100, that's like $40 billion for JP Morgan. It's like a $30 billion profit. I mean, this is this is table stakes for them. They're not in it for, nickel and dime. Yeah, if they're nickel and diming, 2 million credit card customers at a time, then the nickels and dimes add up. But if they got 400 million ounces of silver, like I allege, okay, I think that's probably the most bullish thing you could say about silver. The biggest crook has got the biggest position. The way he's going to make money, okay, is if the more it goes up. That's just the probability. Can I guarantee that? No, of course not. Is it possible that they could sell? Yeah, it is. But is it probable? I don't think so. But what for? What do they got to gain? They're like out to steal every dollar that's not nailed down. They're bigger than the U.S. government. I mean, people think sometimes that the U.S. government's going to keep the price down and protect the dollar or the stock market or something. Okay, I say there's a simpler explanation. J.P. Morgan depressed the price these last 4.5 years precisely to acquire this silver, and they have no interest, in my mind anyway, of letting loose of this silver except at some extraordinarily high price.
Wow. Well, thank you, Ted. Thank you for that, and thank you for taking the time to follow up from our interview series and answer these questions. I actually have another, probably 10 or so questions, and there were a couple that I didn't get to. I'm sorry if I didn't get to your question. I tried to combine a few as we went along. Maybe we can do this again at some point, but I want to remind everyone here who came, and thank you for coming, that you can find Ted at butlerresearch.com. I will have a replay of this will automatically be generated. If you had any sound issues or video issues, I'm sorry about that. Sometimes there are variations in the internet connection. You can we'll also have a transcript that I'll probably kind of break up into sections because we went for a long time. And you'll be able to listen to this. There'll be an audio or a podcast format of this. And yeah, again, thank you so much, Ted, for taking the time out. We're getting a lot of thank yous here from people in the chat room. Everybody really appreciates the work you do. It's sort of a thankless adventure. Again, as I said in the beginning, a lot of this commentary is unfortunately ignored. It's tough to wade through a lot of this. Most of our followers take the time to do it, but it requires a certain amount of work. And in this world of low-hanging fruit or information or distraction, it's a testament to the people who are here also who take the time to figure this stuff out. So until the next time, Ted, take care, be well. Thank you so much for joining us, and the same for everyone here. Take good care, and we'll talk to you guys soon.
Thank you.
Hey, stay right there. I'm really excited for two reasons. Number one, we have Ted Butler with us for a question and answer. And number two, once again, I get to present this using this format, which is really cool. We will have a replay, we'll have a transcript, and you can watch this, but you'll also be able to listen to this as a podcast. And as many of you know, we're doing this is a special broadcast. We're doing a question and answer with Ted Butler. Many of you saw the interview series that we put together. I broke it up into 3 parts. If you didn't actually see that, I'll show you how to see it in just a minute. I want to find out first off who you are and where you're from. If you could type your name in the chat box, either to the right or at the bottom. I'm Jeff Lewis. I'm in San Francisco, California. Ted, where are you?
I'm in Cape Elizabeth, Maine.
Cape Elizabeth, Maine.
Okay.
Great. If you guys don't know me, for those of you who don't know me, I'm Jeff Lewis. I'm the publisher of silvercoininvestor.com, Louis Mariani Research.com, and we also have our forum at the 47forum.com. If you didn't see the article or the interview series that we put together, you can find it at louismarianiresearch.com. Just type that into the address bar, And then at the top, the menu where it says home, right next to it will say Butler. You can click on the Butler link. It'll take you to part 1 of that interview. They're all linked together, so you can read through, you can watch it, then you can click to part 2 and then see part 3. It's all put together there. Now, most of you know my special guest, Ted Butler, but in case you don't, just to give you an example of his influence on me, the very last article that I read about silver yesterday, Wednesday, was by Ted Butler. And the very first article I read about silver in 2002 was by Ted Butler. And he's been at this much longer than that. I have 4 words to describe him that kind of came to mind this morning when I was thinking about it. Preeminent, objective, almost to a fault. I'll talk about that in a minute. Persistent and consistent. He's preeminent because nobody matches his.
Just to describe it, when I say turnover in the COMEX inventories, I am talking about physical movement. I'm talking about warehousemen taking pallets of silver, five 1,000 ounce bars to a contract, out of various warehouses, being loaded onto trucks, not Brinks trucks, container trucks, and then the reverse of that, taking it out of trucks and putting it into various, the 6 various silver warehouses in the COMEX system. So it's not a bookkeeping entry. It is a physical movement. There's absolutely no reason to be suspicious of the numbers that they might not be reliable, because there really is no motive that I can think of why anybody would misrepresent or lie about the movement. So it's taking place. The big question I have is, because this silver movement started at the most famous time, auspicious time in the history of the silver market, April of 2011, when we hit the high near $50 for the second time in 30 years. And since that date, this movement, this frantic movement, physical movement of silver in and out from the COMEX warehouses onto trucks, in trucks into the COMEX warehouses, has continued unabated for the last 4.5 years. Remarkably, I haven't seen this, and don't see it now, this type of warehouse movement in any other commodity. No other COMEX commodity, no other NYMEX commodity, not a London commodity. You don't see this kind of turnover. And I've been asking out loud for a long time, for the last 4.5 years.
This that Ted's brought up years ago as sort of, it's being accepted now as fact and not a conspiracy. For example, we're now seeing many commentators, including me, are analyzing the Commitment of Traders report, or looking at the COMEX inventory warehouse data that's produced by the CME. Especially we've seen that in gold. So despite the resistance, much of his commentary ends up becoming, I think, part of this. And as a lead-in, Ted, we discussed in our interview JP Morgan's accumulation of this massive physical silver long. And one of the most visible signs of this was the accumulation for their own proprietary account, and that you can see in the data that's produced by the CME every day. And in conjunction with that, you've noticed, and this is something that probably will become accepted at some point, but no one's really talking about this yet, but this frantic, and there really isn't any other way to describe it, but a frantic in and out movement of inventory among the COMEX warehouse system of silver bars, 1,000 ounce silver bars. And so the first question, Ted, is, are you seeing any change in that movement? And I guess the second question to go along with it, is JP Morgan still accumulating, and while this isn't the largest amount of silver that they've accumulated, but it's the most visible sign. So let's start there, Ted.
Well, thanks for the lead-in. Yes, the answer to the question is the turnover, this massive physical movement of 1,000-ounce bars in and out of the six various COMEX warehouse continues. It varies a bit from week to week. The last couple of weeks were just absolutely extraordinary. One week was an 11 million ounce turnover, and last week was 8 million. This week it's cooled off. I don't know today's figures, but it's like 3 million ounces. All of these are extraordinary numbers. And just to set this, why is it taking place? I interpret it and conclude that it's a sign of tightness. The second question you had, Jeff, about is J.P. Morgan still acquiring and silver, and the answer there is yes. I'm up to, my guess is they're up to like 400 million ounces of physical silver that they've accumulated over the last 4.5 years. And this stuff in the COMEX this year, about 20 million additional ounces went into their own COMEX warehouse, the JP Morgan COMEX warehouse. And as you say, that's the most visible, and no one can deny that it looks like JP Morgan taking delivery on futures contracts in their own name and their own trading house account, proprietary trading account, and eventually being moved into their own warehouse, COMEX warehouse. So it's a small amount relative to the total amount that they've claimed. They've moved maybe 5% of the 400 million ounces I allege that they've accumulated this year. But then again, it's not chopped liver either. 20 million ounces is not an insignificant amount, but it's the most visible. It's the least I have to explain and justify as to why it's taking place. And fortunately, this movement starting in April of this year, this 20 million ounces or so that's been moved into the COMEX JP Morgan warehouse, it came after I made the conclusion, the allegation that JP Morgan was buying silver long before they confirmed it with this unusual taking of delivery on futures contracts and the subsequent physical movement of that silver they took delivery of into their own warehouse where
experience. He's been in the trenches analyzing the silver market for longer than anyone. He's been persistent. Really, he is responsible for getting his observations, his accusations in front of the regulatory structure, the CFTC. He's responsible really for 4 silver investigations over the years. And he's been consistent week in, week out. You can find his commentary at butlerresearch.com. Here's the link. Check him out there. I highly recommend it. And then back to the objective part, I think this is a way to lead into our first question. He's objective almost to a fault in what's it's kind of led to this situation where he's kind of ignored in 2 ways. I think his analysis, his commentary is ignored by the mainstream for obvious reasons. Most people don't know or don't care about the silver market, but if they happen to find out about it, usually it's from like a supply and demand kind of a direction, a commodity side, and then they dip their toes in. They may run across an article that he's written, and then they're immediately confronted with a huge technology language. There's a lot of details and a lot of information to cover, and a lot of people just their eyes glaze over. And the other way that he's ignored, I think, is in our own precious metals community. The loudest, the most vocal commentators, they have sort of a stake in believing that the price is a reflection, a real reflection of supply and demand. And if they were to go there, if they really were to, and many of them understand where he's coming from, but if they were to admit it, it would just sort of, it might ruin, it would, sort of sabotage the premise of much of the analysis and the commentary. And with that said, to jump right into these questions, I think that some of what Ted has brought up, much of what he's brought up over the years, I'll revise that, much of what he's brought up over the years has, despite this resistance, has crept into whether it's the unconscious or a consciousness where we're seeing now, even today, analysis